Have you ever wondered how financial professionals calculate the expected return for an asset or a portfolio, and what fundamental beliefs underpin those calculations? Understanding the basic models for asset pricing is crucial for anyone looking to build a robust investment strategy. The core difference between the Arbitrage Pricing Theory, or APT, and the Capital Asset Pricing Model, or CAPM, lies in their assumptions about the factors that drive asset returns. While CAPM is a single-factor model primarily focused on market risk, APT is a multi-factor model that considers several systemic risk sources. The CAPM, a widely used model, operates on several key assumptions. It presumes that investors are rational and risk-averse, holding well-diversified portfolios. Furthermore, it assumes perfect capital markets with no transaction costs, no taxes, and all investors having access to the same information and borrowing or lending at the risk-free rate. Most importantly, CAPM assumes that the only relevant risk is systematic market risk, measured by beta, and that idiosyncratic risk can be diversified away. In contrast, APT takes a more flexible approach. Its primary assumption is that there are no arbitrage opportunities in the market, meaning investors cannot make risk-free profits. APT posits that asset returns are driven by a linear relationship with multiple unspecified macroeconomic factors, which influence all assets to varying degrees. And like CAPM, APT does not assume perfect markets or a single market portfolio. It only requires that investors can construct diversified portfolios to eliminate unsystematic risk. Understanding these distinct theoretical foundations helps investors evaluate which model might be more appropriate for a given analysis. CAPM provides a simpler framework for estimating expected returns and assessing risk, making it popular for quick analyses and introductory financial concepts. However, its restrictive assumptions often diverge from real-world market conditions. APT, being more general, offers greater flexibility to incorporate various economic factors that truly impact asset prices, potentially providing a more accurate reflection of risk and return in complex markets, though it requires identifying and quantifying those factors. A significant advantage of APT is that it does not assume the market portfolio is efficient or even observable, which is a common critique of CAPM instead. APT allows for factors like unexpected changes in inflation, interest rates, or industrial production to be specific drivers of asset returns, rather than lumping all systematic risk into one market beta. This broader perspective helps in crafting more nuanced risk management and investment strategies. Ultimately, both APT and CAPM serve as powerful tools for understanding asset pricing, but they originate from fundamentally different views on market dynamics and risk. By recognizing CAPM's focus on a single market factor and APT's flexible multi-factor approach, you gain deeper insight into the complexities of financial markets. This knowledge empowers you to critically assess asset valuations and build more informed, resilient portfolios that account for a wider spectrum of market influences.